Excellent.
Hold on just a minute. Well, good afternoon, everyone. Cynthia Tomaine here with Interactive Brokers, and thank you for joining today's webinar that's being brought to us by Global X Funds. Our topic for today's presentation is looking ahead with thematic investing. Now, we're very pleased to have Michael Hoffmann, a research analyst with Global X Funds, deliver today's presentation. So with that, Michael, I'm going to go ahead and pass you the controls. If you would share your desktop, we'll get going here this afternoon. Thanks for joining us, Michael.
Thank you, Cynthia. I'm delighted to be here. And hello, everybody. Thank you for taking the time to join today's webinar. As Cynthia said, we'll be discussing looking ahead with thematic investing. I'm a research analyst at Global X, and I focus primarily on our thematic suite and thematic ETFs that we'll be touching upon today. Now, to offer a little bit of background about Global X, we're an ETF issuer based out of Manhattan. And we have close to 70 ETFs now, many of which trade commission-free and interactive brokers, and close to $10 billion in assets under management. Many investors are familiar with Global X for our income suite, which includes Super Dividend family of ETFs, as well as a rapidly growing thematic ETF suite that we'll be talking about today. The thematic suite currently has 14 products and several billion in assets. And for the thematic suite, we focus a lot on disruptive technologies, people and demographics, infrastructure development, and we'll walk through some of those themes today. Now, what we'll be focusing on today is thematic investing, and I want to start off by discussing two different investment approaches. So first, many portfolio managers are often faced with the tension between building a portfolio based on what they've learned from the past and their expectations for the future. So on the left-hand side, you'll see that approach. With the rise of smart beta strategies, we've seen many investors focus on historical stock patterns repeating themselves in an effort to outperform a broad market index. Thematic investing, however, takes a different approach, more oriented toward the right side of your screen. It's forward-looking in nature, and it's based on the premise that future themes will have little resemblance to the past. We're expecting a major paradigm shift when talking about disruptive themes, and they're often a growth-oriented investment approach. So to dig further into this topic of thematic investing, we'll first start with an overview of thematic investing based on our research at Global X over the past few years, and we'll also explain why we think thematic investing is particularly important in the current environment. Then we'll dig into some of our highest conviction themes, including robotics and artificial intelligence, lithium and battery technology, the Internet of Things, Fintech, cloud computing, and genomics. After that, we'll briefly discuss how to incorporate different thematic investing strategies into a portfolio. We're going to leave a few minutes at the end for Q&A, so if you have any questions at any point today, please use the questions box on your screen to submit a question, as Cynthia kindly indicated. Now, what is thematic investing? Starting at a high level, we define it as the process of identifying disruptive macro-level trends and underlying investments that stand to benefit from the materialization of those trends. And this often requires a two-step process. So first, we at Global X identify themes that we have a lot of conviction in, themes that we think will disrupt the global economy. Second, we work with an index provider to develop a methodology that identifies the companies that stand to benefit from those trends. So one, we want to have the conviction that these trends are actually going to have a powerful impact on markets and society. And second, we want to make sure that we can find a broad group of companies that have enough exposure to the relevant theme. And because of the strategy, it tends to be longer term in nature, and it's often unconstrained by geographic and sector definitions. So if you think, for example, a theme about robotics and artificial intelligence, that type of innovation is happening all over the world, not just in any one country, and it's also being adopted by many different sectors. Not just industrial manufacturing, for example, you can think of robotics in healthcare for surgery or exoskeletons. And because of the nature of thematic investing and these characteristics, it often has low correlations to other growth strategies and relies on really relatable concepts that any investor can understand. Now, we're often asked, how do we choose the themes that we launch in an ETF? And it really comes down to this three-part test that we're describing. One, it's the high conviction in the theme playing out the way we expect it to. Two, the theme must be investable, meaning that a basket of securities exists with high exposure to the theme. Usually we like this to be at least 20 companies. 25, 30 is even better. And often with some themes, you'll see even more depending on the maturity of the theme, the nature of the theme, and the type of exposure that the companies offer. Lastly, the time frame must be fairly long-term, ideally decades or even longer. We want less of an emphasis on short-term themes that might be mean reverting. And now, when we talk about thematic investing, we want to make sure that we're talking about the structural themes, because there's two different types of themes, cyclical and structural, and it's important to distinguish between the two. The cyclical themes occur at shorter and more medium-term intervals, typically based on changes in the business cycle. And these can be mean reverting. So over a longer period of time, they tend to converge on some average level. They're not that one-off shift that changes an existing paradigm, as you'll see with the S-shaped structural theme. And so examples of cyclical themes can include housing market, asset valuations, volatility, interest rates, all things often based on the business cycle. And again, structural themes will follow this S shape of adoption because it's really fundamentally changing an existing paradigm. And because of that, it tends to be longer term in nature as the technology or the trend is more widely adopted and disseminated. And again, it's typically driven by powerful forces such as disruptive technologies, changing demographics, as well as changing consumer preferences and behavior. So to dig a little deeper into what disruptive growth looks like, we have this S-shaped curve that was actually explained by E.M. Rogers' diffusion theory of innovation. And it explores how new technologies and trends are adopted by markets and wider society. The S-curve shows slow initial adoption as innovators on the left-hand side of the curve take a risk on a new technology. When the early majority begins to buy that new technology, its adoption accelerates rapidly. Eventually, it'll taper off with the late majority and the laggards. And you'll notice that many technologies have actually followed a similar S-curve in the past. On this slide, we highlight previous examples of innovations that have been adopted heavily over time. We have the telephone, electricity, refrigerator, stove, and as we get closer to modern times, the cell phone, computer, the internet. And one thing you'll notice is that the pace of acceleration in the S-curve is actually happening at a much quicker pace. Emerging themes and technologies are adopted at an even faster rate than they used to be. And it's important to track the S-curve because where a technology lies in the S-curve can provide useful insights on the characteristics of the technology. So for example, technologies that are very early in their adoption represent higher risk-reward potential, whereas more established technologies tend to be more predictable, but with less potential upside. And we tend to think that the sweet spot for investing in a structural theme is in the early adopter stage, because already you've had the innovators that have tried and tested a new technology by experimenting with it, and the early adopters are the ones that are starting to bring that technology to a wider scale, but still yet before that rapid pace of acceleration and adoption occurs. So this next slide gives an example of current emerging themes and where they stand on the S-curve. So it's still very early days for robotics and electric vehicles. As you'll see on the left-hand side, the penetration and adoption is still relatively low. However, wearables are a little bit higher. There are a lot of people with smart watches and smart homes. And social media is now already in that early majority stage with 42% active social media users globally. However, as you can see, it's still a compelling theme, and there's a little bit more room for it to grow over the long run. More than half of the population globally still has not adopted social media. So why do we think it's now an important time for investors to be considering incorporating thematic investment strategies in their portfolio? Well, we believe that these rapid advancements in technology and the changing consumer preferences are actually disrupting existing paradigms throughout the economy for the long term. And many sectors are in the crosshairs of these disruptive themes. One can take a look at consumer discretionary and retail, for example. Millennials are seeing their incomes rise, and they also have very different spending preferences than previous generations. They prefer things like digital payments and e-commerce, living in cities, favoring experiences over buying a home perhaps. Uh, and you can see that trend playing out. There was just a recent data point saying that 6,000 brick and mortar retail stores have already closed this year, a record that matches and even beats what happened year to date in 2018. So we're seeing these trends happen in our everyday lives. Another example is lithium ion batteries and the shift to renewable energy. You can imagine that there are many individuals or companies that would prefer to use lithium batteries over fossil fuels, particularly as preferences change and there is a greater concern about the environment. But the same model, or the sector disruptor model, can apply to many different industries. Robotics and artificial intelligence is another one that's transforming industrials by creating new operational efficiencies. But again, there are several themes that are disrupting existing paradigms across these industries. Now we'll share a little bit more detail about some of our highest conviction themes, first starting with robotics and artificial intelligence. And we do a lot of rigorous research about our themes to make sure that our conviction level is appropriate for this type of investment strategy. So robotics involves the ideation, creation, design, and application of programmable mechanical devices that can perform tasks and interact with their environments without human input. Many might be surprised to know that robotics has actually been around for a long time, particularly in automobile manufacturing. But as this technology progresses, we continue to see its growth and use in a variety of different sectors. One thing that has really accelerated the adoption of robotics is that these previously used to be very expensive, large tools that required a lot of upfront capital investment and were exclusively limited to large industrial producers or large industrial manufacturers. Today, because of improvements in robotics technology, robots tend to be often a lot smaller, safer, more flexible, more accurate, and cheaper, which has made it more widely accessible to smaller and mid-sized manufacturers, which is creating more competition and disruption in the space. And we'll continue to see growth of that technology accordingly. Now, artificial intelligence is a division of computer science that emphasizes the conception of intelligent machines that can work, react, and learn like humans in order to recognize speech, plan, and solve problems. So if robotics is a machine's body, the AI is the brain. And we actually think that this will unlock a ton of potential in the robotics space because it allows machines to conduct increasingly sophisticated tasks without human input. And if you notice on these two charts, you'll see that the growth expectations for those markets are quite high. They're expected to more than double over the course of the next 4 years, both robotics and artificial intelligence. So what's really driving the growth of the robotics space? Well, there are a couple of reasons, and a lot of them involve the economic incentives due to aging populations, rising labor costs, and the opportunity for performance improvements. So if you think of aging populations in places like Japan, South Korea, and Germany, there have been many quantitative studies that have assessed that these countries are experiencing population declines, thereby having their labor force cut in half of their peak size. And as a result, these countries are often investing in robotics to supplement the labor that's evaporating or aging. And so many industries will depend on robotics for services in sectors like food, hospitality, and healthcare. And there's empirical evidence demonstrating how this trend is already occurring in countries with aging populations. It's happening in the United States too, but just a little bit slower of a rate, given that we're still experiencing some degree of population growth. A second driving factor is labor costs. Costs are increasingly high for human labor, even historically low-cost labor markets like China and other developing countries. So for many firms today, it's now cheaper to employ robotics than to actually outsource overseas. And because of that, costs will likely continue to fall. And lastly is some of the quality metrics that I mentioned previously. Robotics can now produce items quicker and with more precision than humans. They're also safer, flexible, and humans can work alongside robots. And importantly, robotics is increasingly being adopted across many sectors, not just industrial manufacturing and automotive, where that's been its traditional sweet spot. You're seeing uptake in military and defense, healthcare and medicine, transportation, things like smart infrastructure, smart energy infrastructure, even agriculture. You can think of uh, drones, for example, that manage wastewater treatment levels or crop monitoring, uh, robots that do apple picking. We'll increasingly see that their uses in a variety of areas. And one important thing to note here is that China is actually the largest purchaser of industrial robotics, and that's where we're seeing the fastest growth. And interestingly enough, robotic density, or the number of robots relative to the overall population, is actually still quite low in China, and they're one of the countries seeing these rising labor costs. So their pace of robotics adoption has actually accelerated in recent years, and we would expect this trend to continue. Another major driver in China is their heavy emphasis on electric vehicle production, which they're using robotics to help increase that supply. Now, one question we're often asked is robotics a consumer product? Do people want robots in their home? Well, the trick is that robots need to provide value at the right cost. So it really depends on how much more is someone willing to pay for a robot versus a traditional good. So it's going to depend on each person. But if a robotic vacuum costs $1 more, it's highly likely that a lot of people will be interested. If it's $200 more, the number is certainly less. Still, the key is that robotic versions of consumer goods need to provide value and be priced appropriately. If that happens, it's possible they'll tap into a large consumer market that has been relatively untouched by robotics so far. Now, moving on to the next theme, lithium and battery technology, which we briefly touched on earlier. So lithium, if you're not familiar with the resource, is actually the world's lightest metal and has been dubbed white petroleum due to its common usage in state-of-the-art batteries. And a lot of people are familiar with lithium's use in batteries, but the majority of current lithium demand, about 60%, actually comes from non-battery sources like ceramic and glass, lubes and greases, and other applications. But of the 40% that's actually used for batteries, about 3/4 is for personal electronics like smartphones, tablets, and laptops. Electric vehicles only make up about 1/4 of that battery demand, or 10% of total current lithium demand. As you can see from this chart, however, the automotive industry has the potential to massively disrupt lithium demand due to the expected increased adoption of electric vehicles. Batteries could in fact make up 75% of total demand by 2021, in part to rising adoption of electric vehicles, or rising demand for electric vehicles. And when thinking about the supply side, it's important to consider the fact that the world's lithium supply is actually just controlled by a select few producers. 3 producers, in fact, contributed to already more than half of the world's lithium in 2018. And for those of you that follow oil markets, this concentrated production may sound a little bit familiar. There's no formal organization binding these producers together like OPEC, but the oligopoly that dominates lithium still doesn't have that much of an incentive to flood the market with cheap lithium. And in fact, some actually suspect that these producers may intentionally be slow on ramping up lithium supply to support their high margins. And to dig a little deeper into the demand side of the equation, many of you might be asking, why now? Why is it that electric cars are popping up all over the news these days? What's actually changed since a couple of years ago when EVs were still a niche market? Well, there's 2 major things. First is on the cost side. Battery costs have actually plummeted rapidly. Estimates suggest that they've fallen in half over just the last 3 years alone. And this has obviously made electric vehicles much more affordable than they were in the past, making them possible in mass market applications. In fact, electric vehicles are pretty close, as you'll see in that chart on the left, to reaching the estimated cost parity point with the internal combustion engine. And you can imagine that a lot of consumers would choose to buy an electric vehicle once the battery prices reach cost parity with an internal combustion engine that relies on fossil fuels. And it's possible that this cost curve will even fall below the current cost of the internal combustion engine. And the second thing that's changed is outlined on the right-hand side chart, and that's government policy. So while some governments have been supporting EVs for years with tax incentives, the U.S. had a electric vehicle tax incentive for a while. It's actually been taken by a whole new level by a few leading countries that are actually setting an end date for the sale of internal combustion engine vehicles. Many countries like China, Norway are already phasing out many of these models and instituting new emissions requirements. And it's also happening at the city level as well, not just at countries. Many cities like Bogota, Mexico City, Paris are trying to ban internal combustion engine vehicles in order to help mitigate air pollution. There are also things like new gas mileage regulations that are also expected to drive up the cost of the internal combustion engine. So we may see the cost parity point of EVs actually occur sooner than previously expected. Now, bringing this all back to lithium, how much lithium demand could actually be spurred by the adoption of electric vehicles? Well, if you'll notice on the left-hand side of the chart, you only need 5 to 7 grams of lithium for a smartphone, but you need 40,000 to 80,000 for an electric vehicle. So that's almost 10,000 times more lithium than in a smartphone. And if you think about this, the little math, about 1 million EVs would use the same amount of lithium as every smartphone ever made. That means that if electric vehicles reach meaningful levels of penetration, which we've marked on the right-hand side chart, in the car sales market, lithium demand could really skyrocket. And already the car sales market has about 84 million cars a year. So if you imagine that we actually reach 100% adoption of electric vehicles or electric vehicle penetration, what that implies is that we need 28 times current total lithium production. So you can see how the impetus for strong long-term demand is there. But the real test as to whether or not electric vehicles will go mainstream is actually it depends a lot on whether or not the automobile industry is on board and willing to adopt this technology. However, they've been overwhelmingly and almost universally interested in pivoting to electric vehicles. Here we list just a sample of automakers that have actually committed to electrifying major portions of their fleets over the next few years. They're spending billions of dollars in creating new electric vehicle models while also phasing out vehicles with an internal combustion engine. And in fact, you only need to take one quick glance at the news cycle to see that commitments by these automakers are actually increasing over time. It's not infrequent that you'll hear in the news that certain companies are planning to invest even more or dedicating more budget to building out their electric vehicle fleet. Now, moving on to our third theme, the Internet of Things. So to define the Internet of Things briefly, it describes a growing network of connected devices that contain sensors, chips, processors, and also have the ability to interact with other devices on a network. You'll notice in this chart that describes the ongoing growth of connected devices that the lion's share is actually not mobile phones or PCs, laptops, and tablets. It's actually tons of other devices like wearables, smart speakers, even connected cars that are actually the largest share of growth, and in the billions, as you'll see. So what's driving the growth of the IoT? Well, first is rapidly falling costs for chips. The fact that semiconductors and chips for compute and storage have fallen so rapidly makes it easier to just connect any item to the internet. And another impetus is improving internet speed and coverage. You've probably heard a lot about 5G over the past year, or especially over the most recent months. But as 5G accelerates, it'll help provide the increased speed, capacity, and minimal latency that will enable these devices to actually transmit data effectively. So you can imagine the implications for many different kinds of connected devices like robotics, even autonomous vehicles. There's also strong consumer demand for IoT products, things like wearables, smart home devices, some of those other technologies that we saw previously on the adoption curve. And there's an enterprise side to this, right? We'll see the IoT increasingly used in industrial manufacturing, smart infrastructure, healthcare, and even real estate. And, as mentioned, the IoT really plays a critical role in many of these themes that we're seeing emerge today. And we'll talk about this later, but themes don't actually have to emerge in isolation. In fact, our conviction is often augmented when we see it tied to other disruptive themes. The Internet of Things, for example, will be a crucial enabler of robotics by actually collecting and providing the data necessary to fuel robots' activity in a factory. And so who do we think will actually benefit from the Internet of Things, or the emergence of the Internet of Things? Well, we list three different categories of companies, including the connected device manufacturers themselves, those that are creating these connected devices. Second, the network infrastructure providers, so those that are actually creating the communications equipment that will support things like 5G technology or 5G networks, guaranteeing fast, secure, and reliable connections to transmit information from one device to another. And also the semiconductor manufacturers, as these companies are creating many different kinds of chips, sensors, microcontrollers that enable a variety of applications, even things like artificial intelligence at these edge connected devices. And it's important to think that the Internet of Things is really looking at objects that were previously not transmitting information, and now fitting these objects with sensors and connecting them to a network, right? So traditional computers and mobile phone companies, as we mentioned, are typically ignored from the IoT because they're the original connected devices. The IoT is focusing on new devices that are only now being connected to the Internet and will witness the most growth. Moving on to Fintech. So Fintech is a pretty broad theme that includes a variety of disruptive companies. They're focusing on products like mobile payments, crowdfunding, peer-to-peer lending, and they're also even just simply enhancing traditional financial services in areas like process automation, risk analysis, and specialty software. And there are many different technologies involved, including some of the ones we've mentioned, like the Internet of Things and artificial intelligence, right? They're changing different parts of the financial services ecosystem. If you think about insurance, for example, connected cars or auto telematics are helping determine rates or supporting underwriting decisions. So there's a lot of opportunity in various parts of the financial services ecosystem to adopt new technologies. So I want to discuss one key trend within FinTech, because obviously it's pretty broad, and that's the digitalization of banking. So we all likely have access to our banks, perhaps even online, but if you take a deeper dive, there's still a much greater level of digitization that's happening at banks and that they hope to achieve. It's not just affecting the major U.S. banks. This is happening globally and even at a local level, regional banks, credit unions, etc. So let's first consider a bank that has poorly digitized. This would be a bank that has customer data that's siloed across the organization. It has software that's not very well integrated, probably patchworked together by different acquisitions, and just generally the organization doesn't have a unified approach to technology. So this bank is, as you can imagine, going to have a lot of issues competing in the 21st century. They won't be able to provide the one-stop shop to customers for online banking that many consumers now demand, especially younger generations. Such a bank will barely know who their customers are, and they'll struggle with things like risk assessment. They'll spend a lot of their time and a lot of their IT budget managing this hodgepodge of software together, rather than actually developing the latest tools and client offerings that customers are demanding. So instead, if we consider a bank that has actually successfully digitized its entire system, it's going to look a lot different, right? And that's what we list here in those orange boxes. Such a bank would have digital offerings available anytime, anywhere for their clients. They'll deliver a personalized experience to their customers because of all of their data that's been consolidated and interpreted cross-functionally. Data is updated in real time, providing a better user experience for customers. And given an aggregated and organized data structure, the company can employ predictive analytics to really understand the customer and even predict their behavior in the future. It will also reduce costs and create many other internal efficiencies. Now, if we think about another area of fintech, digital payments, moving outside of the enterprise software space for banks, this is another area of fintech that's impacting our everyday lives. There's just really an astonishing number of ways to pay for something right now. If you think about buying a cup of coffee at Starbucks, there's really tons of ways you can do it. And so if we think about why there might be so many ways, well, first, it can be challenging for a company to attract a customer. The last thing a business wants is someone to come into their store with the intention of purchasing a cup of coffee and then walking away empty-handed because they forgot their phone or their wallet or don't have a specific medium or ability to pay. So do customers need all of these ways to pay? Not really. But for a business, they want to make sure that they're prepared to process any type of payment. They want to have their bases covered. And that's where digital payments companies come in. They're involved in a variety of areas of the ecosystem, whether that's facilitating payments for mobile, digital, or even cryptocurrency wallets, or they're allowing payment via peer-to-peer money transfers, or they're accepting these payments in a point-of-sale merchant system. And what's the benefit of digital payments? Well, really, customers, they want reliable, convenient, and secure transactions, right? If you use digital payments, you no longer need to carry a physical wallet. You're not going to lose or have your cash stolen. Still, you have to emphasize digital payments still open up new security concerns as well, like hacking. But surprisingly, or perhaps not surprisingly, many consumers still feel more comfortable paying for something digitally than carrying around lots of cash. Other benefits include data, right? Digital purchases are easier to track, aggregate, and analyze, and that's helpful for both customers and the merchants themselves. And lastly is cost. Digital transactions reduce friction and cost substantially versus traditional methods like cash. And another big catalyst for fintech is the availability of opportunities in emerging markets. So emerging markets really seem to be uniquely positioned to benefit from the rise of tech for a couple reasons. First is that there's a very large market in these economies that have a rapidly growing middle class. And many of these people have historically had limited access to credit. So because of that, competition in these countries has also been historically quite limited. And there's now greater opportunity for innovation and price competition from fintech firms to provide some of these services that have historically been lacking. And because of the growing middle class in these economies, many emerging market consumers are just now entering the banking world for the first time, and they're even more willing to use new technologies than people who have established their traditional habits. That's often referred to as the leapfrogging effect. And not surprisingly, governments of many emerging market countries are often supportive of fintech because it helps move away from a cash-based economy and can provide good jobs. One great example of this is Kenya. M-Pesa is a digital payment system actually owned by Vodafone that is used by a large swath of the Kenyan population. Digital payments are already processing double-digit percentages of the country's GDP. And M-Pesa was successful because it capitalized on some of these trends and acknowledged the services that emerging market consumers needed. Now, to touch on some of our last two themes, we have cloud computing and genomics. I'll first focus on cloud. Cloud computing, that really describes the availability of IT services, things like compute and storage and basic infrastructure, as well as application development platforms and various software applications. And what they're doing is that they're leveraging pooled resources and economies of scale. And the reason it's called the cloud is because these services are often hosted remotely and accessed directly over the internet. So the chart you'll see on this slide outlines the different segments of the cloud computing market. First, you have software as a service, offering those specific software applications over the internet. Platform as a service, which provides the tools for software engineers and application developers to actually build different types of software and applications, as well as infrastructure as a service, which basically consists of that core compute and storage power. And lastly, there are a couple of other players in the cloud computing ecosystem that are also worth mentioning. You have data center REITs, or data center real estate companies. These large public clouds are often hosted in huge giant warehouses that need specific services in order to make sure that the servers maintain secure. They also need colocation services, which basically means cooling them down so they don't overheat, as well as an uninterrupted power supply. With increasing usage of the cloud, you want to make sure that the clouds are running steadily and without interruption. And lastly is actually the infrastructure and components that make up the cloud. These include things like servers, network switches, and routers that are all eventually virtualized and aggregated to support cloud and edge computing activities. And if you take a look at some of those market growth numbers, you'll notice that the expectations for growth are quite high. And part of the reason for that is that the cloud computing is expected and already having a profound effect on emerging business and consumer applications. So if you think on the enterprise side, for example, there's a variety of use cases that are already being adopted, especially at the SaaS or software as a service level. That can consist of things like enterprise resource planning or ERP systems, as well as customer relationship management and CRM, even things like compliance, human resources, cybersecurity, and more. So there's really a variety of cross-functional applications for cloud computing tools. And at the same time, cloud is a foundational technology for a lot of new emerging technologies like AI and IoT. Cloud will provide the necessary infrastructure, including the compute power and the storage capacity, to run artificial intelligence algorithms and also to process all the data that's collected and transmitted via the Internet of Things. Further, you see it increasingly used in consumer-facing application. The launch of a variety of streaming services, whether it's Netflix, Disney, or Amazon, rely on cloud-based tools to actually stream their content. And we'll see it increasingly in other spaces like augmented and virtual reality and even gaming. Google just this past quarter announced the launch of Stadia, which will be their cloud-based gaming platform. And another benefit about cloud computing is that it actually offers a network effect. Cloud companies, they really benefit from economies of scale and increased use of the platform. Not only sort of at this infrastructure and compute level, but also even at the application level. If you think of a SaaS cybersecurity company, right? As more users begin to use its platform, the company can gather better intelligence data and push out preventative cybersecurity measures back to its customers in a continuous fashion, all via the cloud. And it's also an attractive business model, which is another reason it's been adopted so heavily by businesses and really transformed enterprise IT. Before cloud computing was adopted, companies had to host all of their IT infrastructure on premises. Cloud computing instead offers a more predictable service-oriented or consumption-based model for those same IT resources. So instead of paying a software licensing cost, plus having to do extensive training, customization, implementation, hosting all of that hardware on site, and hiring IT personnel just to maintain all of that hardware and ensure that it's interoperable, now companies can just pay a recurring subscription fee and do much less implementation and customization to have their IT infrastructure work effectively. And again, the falling cost of compute and storage have strengthened the benefits of economies of scale and made public cloud investments more attractive. And I mentioned things like maintenance and interoperability because those were actually really big pain points for IT administrators for a long time. Now that cloud computing and public cloud infrastructure is really operated by a third party, business IT personnel, they don't have to spend hours and hours on maintenance, and instead they're freed up to work on other tasks like developing better apps for their customers while saving costs at the same time. And moving on to discuss our last theme, genomics. So genomics is another exciting theme that we really think could revolutionize healthcare. And genomics basically describes the study of genetics and the use of genetic information to inform healthcare and medical decisions. And what's driving interest in genomics? Well, one big factor is the falling cost of human genome sequencing. The Human Genome Project was a U.S. government-funded project that began about 2 decades ago. And when that first happened, to sequence the human genomes for the first time, it cost around $100 million just to sequence one human genome. As you can tell, the cost per genome sequencing has fallen at an incredibly rapid pace. What was once $100 million is now closer to $1,000 or even $100, depending on the quality of sequencing service that you would like to purchase. Still, there are even other drivers. One is the potential of curing previously incurable diseases. Improved understanding of genetics is making it possible for scientists and biomedical researchers to develop innovative therapies and treatments that address previously unsolved genetic disorders that might have been a fatal death sentence, essentially. There's a lot of innovation in that space to treat diseases that were previously seen as a lost hope or lost cause. There's also an increasing emphasis in the medical community on something called precision medicine, which is another way you can think about precision medicine is personalized medicine. It seeks to improve patient outcomes by really taking a personalized approach to healthcare, understanding the unique genetic traits, behaviors, and characteristics of individuals to optimize sort of their treatment decisions and health outcomes. And lastly, with the rise of genomic sequencing, we've begun to gather so much genetic data. And genetic data is actually really, really dense. Estimates suggest that by 2022, for example, we'll have collected more genetic data than all of what will be hosted on YouTube and Twitter combined. So you can just think of the massive opportunity of insights that we'll be able to collect by continuously gathering and aggregating genetic data, especially to identify new treatment opportunities for some of these diseases that previously had no recourse. So to better understand the genomics industry, and I've mentioned some of these already, but there's actually 4 specific subcategories that we think make up the genomics industry. First is genomic sequencing, and those are companies that are offering the tests or the processes that help determine the exact order of one's DNA. There's also computational genomics, which is more on the data side of things. They're using computational and statistical analyses to gain insights from our genomic sequences. For example, I can think of one company that focuses on computational genomics strictly for cancer. You can imagine that there are a lot of people with the same type of cancer and receive the same treatment, but not all of them have the same outcome. Some will go into remission, others won't. And computational genomics seeks to understand the data that's been sequenced to help better understand why some individuals might have a positive treatment outcome, whereas others respond poorly to chemotherapy, for example. And that's in turn used to help recommend certain treatment therapies and options. So gene therapies is another subsector of this space, and gene therapy companies are basically seeking to develop treatments that help detect, cure, or treat diseases by identifying and modifying an organism's gene expression or functioning. And I want to be clear that this differs a little bit from gene editing, which actually inserts, deletes, or replaces DNA at a specific site in the genome of an organism. So gene editing is actually changing the actual sequence of your DNA, whereas gene therapy is usually a treatment solution that understands the process of gene expression, which usually involves proteins and enzymes and RNA, and changing something in the gene expression process to help treat a disease. Whereas gene editing will actually change your DNA to help avoid any number of genetic disorders. And as you'll see on the chart on the left, there's actually thousands and thousands of diseases that are just caused by a single gene mutation. Things like sickle cell anemia, hemophilia, cystic fibrosis. And these are just a few that affect thousands, hundreds of thousands, and even millions globally. So you can see the massive potential that exists for improving treatment outcomes with people that suffer from many of these genetic disorders. And the hope is to apply advances in genomics not only to single gene diseases. There are also other diseases like Alzheimer's and diabetes that are much more complex and related to the expression of not just a single gene but multiple diseases. And the hope is that genomics will help address some of those more complex diseases as well in the future. And this next slide just shows some of our expected market growth statistics for the various subsectors of the genomics market, but it also spends a little bit of time outlining or explaining the rise of precision medicine, which again, it refers to personalized medicine or using a patient's genetic information to identify the most optimal treatment option for any type of illness. And I really like this image because it describes some of that cancer treatment decision making that I was describing, right? An individual with cancer taking a personalized medicine approach or precision medicine approach, you can personalize diagnostics by actually looking at their genetic sequence, doing tissue analysis, taking a blood sample, and then based on that information, actually giving different groups of people different types of therapies so that they can all have positive treatment outcomes. Because we've learned that using sort of a one-size-fits-all approach to medicine doesn't always work. And so as we close out this webinar, and I mentioned this earlier, it's important to remember that no theme comes in isolation. There's this quote from McKinsey that says, the most attractive opportunities are often found when multiple themes converge and reinforce one another. And in this chart, we outline multiple instances where we're seeing a lot of themes converge, right? Even sometimes unexpectedly. So you have the Internet of Things with your wearable. How is that related to lithium? Well, lithium can actually create some of the batteries that are implanted in wearables. How do social media and Fintech relate? Well, through crowdfunding and peer-to-peer lending, right? So it's very common to see these themes merge together, and that often reinforces our conviction in them because we know that they're not occurring in isolation and that there are other powerful drivers behind them. So where does thematic investing fit in a portfolio more broadly? Well, as we mentioned earlier, we think it's best for long-term horizons, right, and growth-seeking investors. A major challenge, however, is how to fit thematic in a portfolio when it transcends typical geographic and sector classifications. So what we recommend and what we've often found that works best is that investors feel the most comfortable when they've actually carved out a thematic or opportunistic bucket in their portfolios, where they ignore things like traditional geographic or sector classifications. And this segment usually comes out of the equity bucket of their overall portfolio. And it's important to emphasize or at least consider the risk and return characteristics of thematic investing and when creating a portfolio of themes, right? You want to try to capture the growth while mitigating risks associated with any one theme. One potential way to approach this challenge is to own a basket of themes and to weight those themes by forward revenue growth expectations. This helps diversify exposure to any one theme while still tilting exposure to higher growth potential themes. And this is where we spent a lot of time doing research and developing products that capture these themes at Global X. Global X has a variety of growth-oriented thematic ETFs across many of the themes we discussed and more that really touch on some of these drivers related to disruptive technology, people and demographics, and changing consumer preferences and behavior, as well as infrastructure. And many of these trade commission-free on interactive brokers. So with that, I'd like to say thank you to all the attendees as well as interactive brokers for hosting us. Please submit any questions you have at this time in your question box. And I'd also like to display our disclosures very briefly for a second. And to close out, I'd like to address one question that we commonly get, and that's what themes are we most excited about in the current environment? And as I think about 2019, the two themes that really come to mind is one is the Internet of Things, and in part that is because of 5G is such a major catalyst. As 5G network infrastructure is being built around the globe, that'll help support millions of new connected devices being connected to networks, and there's a great opportunity there for even more advanced applications over the long run, things like autonomous vehicles that 5G will help support. A second theme that I'm excited about currently is genomics. There's been a lot of recent innovation in this space, and many of these new treatments, gene therapies, or gene editing technologies have just started to undergo clinical trials. Some have received breakthrough therapy designations from the FDA. Some gene therapies are already receiving regulatory approvals, and we'll just see a lot of activity and innovation in the genomic space that can hopefully help cure a lot of life-threatening diseases. With that, let's see what other questions we might have. So one question we get is, how come we don't have a blockchain ETF? And the reason we don't is that if you think back to some of the earlier part of our presentation where we thought about the criteria that help us define disruptive themes, right? That's conviction, investability, and time frame. While there are a lot of companies experimenting with blockchain, and there have been some cryptocurrencies developed, we don't think that blockchain actually meets our investability test. There isn't a large basket of companies or securities that have really pure play or 100% exposure to blockchain as a theme. It's often occurring in isolated circumstances or an experiment at a larger company where it has no meaningful revenue impact to the company. So it's actually, even if they might be exploring the technology or experimenting with it, that doesn't mean that we can actually create an ETF that will provide reliable exposure to the blockchain theme. Having said that, we obviously have a Fintech ETF that we think captures widespread innovation in the financial services ecosystem, and there is a subcategory for blockchain and cryptocurrency developers. However, still, there are very few pure play companies yet, so the exposure there is limited. But as those companies continue to grow, we might expect them to be added to our Fintech ETF, for example. Now, it looks like we have another question from the audience. So, two questions. How would you advise investors to devise a thematic portfolio based on themes presented today? And what sources of information would you recommend us to tap into? So for one, we at Global X, this is our bread and butter. We live and breathe thematic. So I would encourage you to look at many of the research that we've published at globalx.com/research. We have a lot of insights, charts, data, rigorous research exploring many of the different themes that we've discussed. And how to devise a thematic portfolio based on these themes? Well, I would think back to what I mentioned earlier about carving out a thematic or opportunistic bucket in your broader portfolio, especially in the equity section. And it's, again, one way to approach the weighting scheme there, again, is to think about those themes in terms of their forward revenue growth expectations, right? So in that case, you can diversify your exposure across multiple disruptive themes, like you mentioned, robotics, AI, and the Internet of Things, while still tilting exposure to some of the higher growth potential themes. I should also mention we at GlobalX have developed several model thematic portfolios that are hosted on InvestNet, and you can always reach out to us for more information about those as well. And it looks like we don't have any other questions at this time, but thank you all for attending today, and thank you again to Cynthia and Interactive Brokers for hosting us.
Well, Michael, thank you. Very informative today, and you've covered an awful lot. So I do want to remind everyone that we have been recording today's presentation, and each of you will get a direct link to today's recorded playback, as well as a link to the slides that Michael's been using for today's presentation, just in case you want to come back and review any of the concepts that were discussed here today. Simply watch your inbox later on for those follow-up messages. By the way, this information will also be posted on the Interactive Broker website. Underneath the Education menu, you'll find a webinar section where you'll be able to find today's presentation, and those same webinar notes will be listed. So with that, much thanks to GlobalX for bringing us today's information. Thank you so much, Michael, for today's presentation as well. Now, you can exit using the X in the upper right-hand corner of your screen and watch your inbox later on for a direct link to today's recorded playback. So with that, thanks to all of you for participating in our event today. Have a great rest of your day, everyone, and thanks so much.